Good day, everyone. Welcome to our confidential report for November 2022. We'll begin as usual in America. And there, obviously, we have to grasp hold of the overriding truth that we are in a bear trend. I've been surprised at some of the reporting coming out of America, which has indicated that there are still people who do not believe that the bear trend exists. But I can assure you it does. And while the market might go up for a few days, a week, even 2 weeks, even 2 months, as we saw between the middle of June and middle of August, we are nonetheless in a bear trend, and that is the overriding truth of the stock market right now. In the past 2 weeks, we have seen a resurgence of optimism. You can see on your screen here the chart of the S&P 500. And this optimism has carried the market up for about 2 weeks, culminating in a 2.46% jump on Friday last week, which you will notice reached this support and resistance line at 3,900 or 901, and then is now in the process of falling back from that resistance. The bulls have managed to convince themselves somehow that the Federal Reserve Bank and its Monetary Policy Committee will pivot in its policy. In other words, it will, for some reason which I can't fathom, reverse its policy of raising interest rates to control inflation. But Jerome Powell, the governor of the Reserve Bank in America, has said quite clearly that inflation must come down to 2%. And he will continue to take measures to do that, to bring it down to 2%. And that probably means that now in November, he's raising rates by a further 75 basis points. So he will use both rising interest rates and quantitative tightening simultaneously to bring inflation in America under 2%, and that will inevitably begin to impact on corporate profits sooner or later. We have pointed out in previous confidential reports that this bear trend, in our opinion, began about 18 months early, mainly because of the impact of the Ukraine war, which pushed oil prices up and accelerated nascent inflation, which was basically caused by quantitative easing. So there was the potential for inflation, and the only thing that was really holding it back was the oil price. Once the oil price started moving up towards $100 a barrel, we saw that inflation surface very quickly. So we originally thought that the bear trend would begin in about late 2024. But instead it began this year, and now it has been going on for 10 months. And of course, this early start has left a certain unusual bullishness in the markets. This is visible in the enthusiasm with which rallies in this bear trend are followed. But most investors in the market that we are in now have never seen a bear trend before. It's something completely new for them. Most came into the market after 2009. So all they have seen is a 13-year bull trend, and they do not understand what is happening because they have no previous experience of it. And of course, we are concerned that this particular bear trend may be worse than normal, because the bull trend, the 13-year bull trend, was artificially sustained by quantitative easing and very, very low interest rates or zero interest rates. That accommodative policy was then extended by a response to COVID-19. Now, the central banks, especially the Federal Reserve Bank, are faced with rampant inflation, and they are forced to raise interest rates much more quickly than they would otherwise. The Fed is raising rates about 3 times faster than normal. In the past, the Fed funds rate was raised at 25 basis points at a time. In this tightening cycle, it's rising by 75 basis points at a time. And of course, the economy hasn't yet really taken that into account. So look at the chart here on the screen. You can see there's the record high over there. And there's the reverse golden cross that we talked about in the last confidential report, where the 50-day exponential moving average crosses down through the 200-day simple moving average. And that is a fairly good sign that you're in a bear trend. And as you can see, since then, the 50-day exponential has remained below the 200-day moving average, in fact, considerably below it. And this rally that we've seen for the last 2 weeks really has only flattened the 50-day exponential out, but certainly hasn't brought it anywhere within striking range of this 200-day moving average. As we pointed out earlier, we've hit the resistance here at 3,900. Personally, I do not think it will penetrate that level. I think it will fall back from that level, and then I think it's going to go back down and test the low here, which is at 3,585, or even in fact 3,777, which was made on the 11th of October, the 11th of last month. So, of course, what that means is that the current rally will run out of steam. It's again misplaced, and it will not cause a golden cross buy signal in our view. So we're still in the bear trend. You'll also notice from this chart that the 300-day moving average, which is the blue line at the top here, is falling steadily. In fact, its downward trend is accelerating. That is another indicator which you can use, the long-dated moving average, to determine whether you're in a bull or a bear trend. So we think that this bear trend is far from being over. It's not over. It's only just begun. We predict that the Fed will continue to raise interest rates by large amounts. And of course, this rally that we're seeing now, this 2-week rally, will encourage the Fed to raise interest rates further, as will the rising company profits. There's not much to indicate yet that consumers and businesses are feeling the pain which Jerome Powell said was inevitable at the Jackson Hole conference. He talked there about consumers and businesses feeling pain. Well, there's very little evidence of that as yet. The US housing market has come off a little bit. Existing home sales were down 1.5%. There's been a bit of a sell-off in high-tech shares. Tesla, of course, had some bad third-quarter earnings. And, of course, real interest rates are still substantially negative. In other words, the inflation rate is still much higher than the level of interest rates in America, which means that real interest rates, which is the nominal interest rate minus the inflation rate, is still negative. Inflation is above 8%. The 10-year T-bill has a yield of around 4%. So there you've got it. And that means that there's no incentive for consumers and companies to save yet. In fact, they are still incentivized to spend. For the Fed to pivot in their policy will require clear signs that the US economy is cooling, and we see no such signs at this stage. Historically, the stock market anticipates the economy by between 9 and 18 months. The downward trend in the stock market means that the smart money expects the recession to commence in late 2023. This situation is difficult for novices to understand. 75% of S&P companies are still putting out profits which are above the estimates of economists. So far, for the second quarter of this year, 87% of S&P companies have reported, and their profits were up a whopping 6.7%. In the third quarter, 129 of the S&P 500 companies have reported, and they are a very mixed bag. Microsoft and Alphabet disappointed, but General Motors produced a solid set of results, quite unexpectedly. Year-on-year predictions are for earnings to rise in the third quarter by 3.3%, but this prediction has already been modified down from where it was at the beginning of October, which was 4.5%. So you can see, even the economists are beginning to understand that we are moving into some kind of a recession. But, the oil companies are doing well. Chevron reported an 11.5 billion rand quarterly profit. Exxon reported a whopping 112 billion rand profit. And of course, they're benefiting from the higher oil price, and that is a direct result of the Ukraine war. Amazon and Apple gave very weak guidance. Meta, which owns Facebook, dropped 24% on Thursday last week. But if you look at the gross domestic product in America, it was up 2.6% in the third quarter, which shows that the recession has not yet started. Some investors are talking about a 50 basis point hike in November, and we think that that is misplaced. In fact, we think that there is a possibility that the Fed could raise rates by 100 basis points. And it's important to understand the cumulative effect of rising interest rates. Successive interest rate hikes add to the accumulated effect of previous hikes. The interest rate burden adds up month after month. Eventually, it must have an impact on consumer spending and on corporate profits. That is why we continue to believe that this is a bear trend and it's not over. All right, let's turn our attention elsewhere. China is a very important part of the world economy these days. It's about 3/4 of the size of the US economy, with a GDP of around $18 trillion. It has been struggling with the Omicron variant of the COVID-19 virus, and also with rising fuel prices as a result of the Ukraine war. Many Chinese consumers are overextended and cannot make their bond repayments. And GDP is expected to slow to just 2.8% growth this year. That's down from 8.1% last year, and an average of 9% growth per annum since 1978. So it's a major fall from that level down to 2.8%. Europe and America are both expected to go into recession next year, and the impact on the Chinese economy will be substantial. China, of course, is a major buyer of commodities, and private investors on the JSE can't afford to ignore the impact of China and the impact that it has on commodity prices and hence on South African shares and the economy here. All right, let's turn our attention briefly to the Ukraine war. We see that war is moving decisively in Ukraine's favor now. Russia's desperate effort to conscript more soldiers is evidence of that. They've also suffered repeated defeats on the battlefield, and we think that Kherson will be taken in the next 2 or 3 weeks by the Ukrainians. All of this is impacting directly on Putin. Of course, winter is coming, which means the whole war machine will slow down on both sides. But Russia has lost significant territory and is poised to lose more, including Kherson. And once Kherson is gone, obviously Crimea is very vulnerable. The Russian forces are being pushed back over the Dnipro River, and they should be on the other side of that river by the end of this year at the very latest. NATO, of course, continues to supply weapons and other support, which bolsters Ukraine. The situation is rapidly becoming untenable for Russia and Putin. We see some sort of resolution in the next few months, perhaps including Putin's removal from office. Okay, let's come to South Africa now. Begin by looking at the political situation a little bit. A lot of talk about the unions in this last month. COSATU is talking about withdrawing its support from the ANC after the elective conference. That will, of course, have a major negative impact on ANC support in the 2024 elections. In our opinion, in those elections, the ANC will come in with less than 50% and so will not be able to control Parliament for the first time since they took office. They will be forced to compromise with another party. And we think it's most probable that they will compromise with the DA, because the DA is big enough and because their policies are close enough to those of the Ramaphosa administration not to cause too much trouble. And of course, if these two parties combine in any way, they will have a comfortable majority. And we think that that will probably be good for South Africa. The South African Democratic Teachers Union and two other unions split with COSATU to accept the government's 3% wage offer. That's good news, of course, for Godongwana, our finance minister, because he was able to pencil in a 3% increase in the civil service wage bill in the budget. And they plan to implement that unilaterally, which they can do. COSATU, of course, not happy. The remaining larger unions in the civil service will probably go on strike fairly soon. Civil service strikes in the past have not had much impact on the JSE. One good piece of news, the Office of the Presidency scored an unqualified audit report for the first time in 7 years. Can you believe that? Obviously, it's required that they show some sort of good example. The ANC has been plagued by qualified reports everywhere since it took power. Right, looking at the economy, we had a very solid budget given to us by Finance Minister Godongwana. Obviously, he was helped considerably by the 106 billion rand revenue overrun, which is mainly due to the commodity prices, which have been in a bull stage. 2/3 of that overrun has been used to reduce the government's debt to about 4.9% of GDP, which is a major improvement on where we expected it to be in February, which was around 6%. 33 billion has been a portion for bailouts to Transnet, Denel and Sanral. But Godongwana says the bailouts will start to decline now. The government is going to take on between 1/3 and 2/3 of Eskom's 400 billion rand debt. So that will have a major impact. We will learn more about that in the February budget next year. The 350 rand social relief of distress grant is to be extended for a further year. That will obviously be a major cost for the fiscus. Infrastructure spend is up from 66.7 billion to 112 billion this year. That's a major change and should be a big boost for construction companies. Godongwana said that the finance department expects growth of 1.9% this year and a growth to average about 1.6% for the next 3 years. All in all, it was a pretty good budget. It was good for investors, and obviously the ratings agencies are very happy because the government debt is down. Of course, the civil service unions are not happy at all. And they've already delivered a strike notice, so I think we can expect some action on that front. But as I said, in the past, civil service strikes have not been very impactful on the economy or the stock market. In the latest 6-month monetary policy review, the South African economy is seen to be doing well, reducing debt, controlling inflation, maintaining a balance of payments surplus. In effect, the country is running at a profit and using that profit to reduce debt. The main budget deficit is down from 129.5 billion to just 42.7. Tax collections were up 12.6% year on year in August. That's just August month. Of course, problems will be a declining commodity prices and load shedding. So as commodity prices come down, the mining companies will make less profits and, of course, pay less in taxes. And they will employ less people. Load shedding is a huge problem in this country and will continue to be a problem while we make a transition away from coal-fired power stations to renewable energy. That transition is going to take some time, but it is certainly accelerating. Manufacturing output rose by 1.4% in August, but it will probably drop in September because of the 25 days of load shedding that we had in September compared to August's just 5 days. And July had 22 days of load shedding. Mining output dropped by 5.9% in August, and that comes on top of July's 8.4% decline. This was obviously due to strike action, to load shedding, and to falling commodity prices. Third quarter GDP will probably be down, and that, of course, will put South Africa into a technical recession. Load shedding brought the ABSA Purchasing Managers Index down to 48.2 from August's 52.1. So that's a good impact, a good indication of the impact of load shedding on the economy. The Transnet strike was a major logistics problem, although that has been resolved. It forced Transnet for a week to declare a force majeure. It's been settled with a 6% pay increase after 1 week. And that's against what the unions were asking for, which was 15.5%. What is noticeable is that the level of inflation, the rising level of inflation, was used by the unions as a major bargaining tool in their negotiations. Roger Baxter, who's the now retiring CEO of the Minerals Council, says that the strike added to Transnet's already bad efficiency record, which was before the strike was costing 50 billion rand a day. The mining industry could generate 150 billion rand more, generate a further 27 billion rand in tax, and employ 50,000 more people if the problems were solved. That's what he says. Kumba, of course, was forced to declare a force majeure as well, and was losing about 120,000 tons of exports a day while the Transnet strike was going on. The Bank Serve Index, Economic Transactions Index, is a level of the transactions in the economy. It shows money moving through accounts, and it fell for the fourth month in September. And that, of course, is because of the weak state of the economy, load shedding, higher food and inflation prices, and fuel. The South African economy is almost certainly in a technical recession at the moment. And if we look at I just want to look at the JSE overall index. Sorry, I've got to just get this right here. Look at the overall index, and you'll get an idea of how this bear trend is playing out now on the JSE. So I'm just going to put a bit more data on the screen. Let's go to 1 year actually. Here you can see that the JSE made an all-time record high on the 2nd of March this year. So it was about 3 months behind Wall Street. And since then, it's been in a downward trend. You can see that our market has been rallying in the last couple of weeks in response to the rally on Wall Street. We don't believe it will penetrate this upper channel line, and that the bear trend will continue. So that's our view. It's going to come up here, possibly touch this channel line, and then fall back. Of course, one of the things that is beneficial is that the oil price seems to be remaining below $100 a barrel. The PPI, the Producer Price Index, came down for the second month in a row. And of course, the CPI, the Consumer Price Index, was slightly lower at 7.5%, and core inflation dropped to 4.7%. So it looks like the South African inflation rate is topping out and is likely to drop from here. Retail sales in August were down 1.8%, and that's not surprising, really. It's the fourth month, however, that retail sales have fallen. And I think South Africans are battling, especially with the higher cost of petrol. If we look at the oil price chart, you can see, sorry, I didn't get that. The oil price chart, you can see that oil has come down. Just going to put a bit more data on the screen here. Just want to go back to COVID. Okay, so there you can see the oil price chart. We've got what looks like a double top over here. There's the long-term upward trend line as oil price rises. There's COVID-19, which took oil down to about $25 a barrel. We've got a bit of a downside break over here, possibly. There's no doubt that the oil price has trended down. You remember a couple of months ago, in fact, Joe Biden went to Saudi Arabia and talked to them. We don't know what he said, but I suspect that he made a deal with them to keep the oil price below $100 a barrel. And he did that because it was good for his ratings back home, and also because it's very bad for Russia, of course. All right, let's turn our attention to Eskom. Electricity production was down 4% in June, year on year, and then 7.7% in July and 2% again in August. We expect that in September, electricity production will be down even further because of the 25 days of load shedding that we had there. And we think it will decline even further in the months to come. To us, it looks like Eskom is dying slowly. Certainly as an electricity generator, it doesn't look like it will survive for much longer. More and more people are installing their own systems, and this pattern will accelerate if Eskom gets the 32% increase that they want. Anglo American has launched a company to generate renewable energy. It's going to be called Envusa Energy. The initial objective is to generate 5 gigawatts of power. Firstly, of course, for its own companies in the Anglo Group, but then for other companies and for the public at large. The demand, of course, is very strong. The first energy from Envusa will be delivered in 2025. So South Africa's energy crisis will come to an end, mainly because private enterprise will step into the gap which the government has left, just as it has done in other areas of the economy like education, healthcare, and security. The Rand. Let's have a look at that chart. Get that on the screen. The Rand continues to fall, mainly because of risk-on sentiment. There you can see the chart. It's falling. This chart is falling. Even though the chart is going up, the Rand it's more and more rands for $1. So this chart shows you how many rands it takes to buy $1. And this fall that we've seen since April is very much due to the shift towards risk-on sentiment as the US economy went into, the markets went into a bear trend and the pattern of rising interest rates became apparent. What I have noticed, though, is that there's a definite relationship between the S&P 500 and the strength of the Rand against the dollar. To illustrate that, I've produced a little table. Here you can see it. I've put this table into the notes, so if you want to examine it in more detail, you can. The notes, of course, will be on the website tonight at 6 o'clock. And what I've noticed is that whenever the S&P 500 weakens, the Rand weakens in sympathy. So I've taken the figures from the middle of April right up to the current period, and as you can see here, so on the 12th of April, the Rand was 14.48 to the US dollar. By the 16th of May, it had fallen to 16.19 to the US dollar, so it was down 11.81%. During that same period, the S&P 500 went from 4,397 to 4,008. In other words, it fell 8.85%. Then this is a period of strength from the 16th of May, where it was 16.19. This is the Rand to the US dollar, to the 8th of June. By the 8th of June, it had strengthened to 15.26 to the US dollar, so that was a gain of 5.74%. During that time, the S&P 500 gained 2.67%. And so you can go on looking at periods of strength and weakness down this table. It's remarkable the direct relationship between the S&P 500 and the Rand to the dollar strength. And of course, that's because whenever the S&P 500 weakens, there's a certain amount of international sentiment that shifts towards risk off, you see, and then they withdraw funds from from South Africa because it's an emerging economy. And so the S&P weakens, you get this risk-off sentiment, the rand weakens in tandem. The opposite happens when the S&P strengthens, then you're getting a shift towards risk-on. But the overall trend is that the S&P 500 is weakening and the rand is also weakening. So we've seen the S&P 500, it's in a bear trend. The rand is also, in effect, in a bear trend for the reasons which I have now explained. I would suggest that you take a little time to examine that table and compare it to the charts and see what you think. But it's very interesting. When the S&P 500 goes up, the rand strengthens. When it goes down, the rand weakens. That's what I'm really trying to point out. All right, let's look at some companies now. The banking sector. Of course, when you're in a period of rising interest rates, as we are here in South Africa at the moment, then you're going to find that banking shares do well. The reason is that they borrow money long term, and they lend it and they borrow it long term at low interest rates. And then as interest rates rise, they can lend that same money out at much higher interest rates, and they make a profit on the difference. They can, of course, be hit by bad debts if the economy gets really bad, but they're very skilled at not lending money to people who can't afford to repay it. And they have provisions for their bad debts, of course. As a general rule of thumb, though, you can say that banking shares, the top 5 banking shares, are very solid, high-quality blue-chip shares. And whenever they are on a dividend yield of 5% or more, the big institutional investors will regard them as cheap. Of course, you must never forget that in South Africa we have 3 big institutions: the pension funds, the unit trusts, and the insurance companies. They accumulate massive cash flows because they are charging people every month for their services. And those cash flows have to be invested somewhere. So that, if you're a fund manager with one of those big institutions, you're faced with a huge amount of cash coming into the bank every month, and you've got to find somewhere profitable and safe to put it. And whenever banking shares are on a dividend yield of 5% or more, then they are relatively safe and very cheap. So, the example that I want to just draw your attention to is Standard Bank. And let's just have a look at that chart. You'll see what I mean. Okay, so this is Standard Bank. And you can see down here, in this vicinity over here, it was on a dividend yield of over 5.5%. Now they've come out with pretty good results, and the share's gone up very strongly. And as of last night, it was on a dividend yield of 4.8%. We still think it's got some distance to go up. Obviously, banking shares are not going to shoot the lights out, but they are very solid and very safe. And on any dividend yield that's close to 5%, you can pretty much invest in them and know that you've got a good investment. So that's the first point I want to make. The second point is you need to look at the construction sector. Following the midterm budget policy statement last month, the government has decided to increase spending on construction of infrastructure from 67 billion to 112 billion. This must have a positive impact on construction shares, and you need to look at them. There are 6 construction companies, of course: Avenge, Murray & Roberts, WBHO, Robex, PPC, and Afrimat. Those are the 6 construction companies. Of course, Afrimat is now more of a base metal mining operation, but the others are certainly worth looking at. So we draw your attention to that. Okay, let's look at some other shares. CMH, Consolidated Motor Holdings. This is a vehicle distributorship business. They've got distributorships for a lot of different types of vehicles. They have distributorships for Nissan, Toyota, Volvo, Opel, Mazda, Ford, and many others. They sell both new and used vehicles. In their results for the 6 months to the 31st of August, their turnover was up 11.7%, and headline earnings per share were up a whopping 51%. These are excellent results because they were achieved in an economy that was facing a chip shortage, first of all, rising interest rates, rising petrol price, and of course load shedding. You can see here that the share CMH made an upside break through its downward trend line, its long-term downward trend line. Over here on the 29th of January 2021, it was then 1400 cents. Since then, it's moved up. It's doubled, in fact, to about 28 Rand a share, and it's doubled in about 20 months since it broke up through that downward trend line. Okay, let's look at Santova. Santova is a logistics company, an international logistics company. They have 19 offices in seven different countries. Of course, they have been impacted by the supply chain problems in the international economy, and they've benefited quite substantially from those supply chain problems. What I want to draw your attention to is that this company has managed to keep costs under strict control, but it's benefited from higher prices for its services. In the results that it produced for the year to the 28th of February, headline earnings per share jumped up 144%. Well, in the last 6 months to the 31st of August, headline earnings per share have jumped another 62.4%. If you look at the chart here, you can see there's a clear unbalanced volume buy signal over here. That unbalanced volume buy signal came on the 27th of October 2021 when the share was 425 cents. And it closed the other day at 740 cents. So it's up about, 74% in a year. Then I'd like to just talk about Dis-Chem. Dis-Chem, we all know, it's a chain of pharmacy stores competing directly with Clicks. It offers cosmetics, over-the-counter medications, prescriptions, and so forth. It has now got 254 pharmacies, 35 baby stores, and 48 Medicare stores, which it purchased on the 1st of October. It's growing both organically and by acquisition. There can, in fact, be a Dis-Chem store wherever there's a Clicks store, and at the moment Clicks has got about double the number of stores that Dis-Chem has got, so there's a huge amount of blue sky potential there. We advised you to buy into the share a while back, and we still remain very positive on it. In a trading statement that they produced just the other day for the 6 months to the 31st of August, they are expecting headline earnings per share to jump by a further 43%. You can see the share has turned and it's on its way up in our view. Okay, let's talk about Altron. Altron is obviously an information and technology company. They operate in the UK, Australia, and in 6 countries in Africa. Just going to put more data on the screen here. Not that much. Let's go back to 2 years, even 1 year. There we go. That's the thing that I wanted you to see. You can see that the share bottomed out over here at around 685 cents, and it's been trending up since then. It recently came down, touched that lower trend line, and it's moving off that trend now. In their results for the 6 months to the 31st of August, headline earnings per share were up a whopping 467%, off a revenue increase of 15%. Obviously, the previous year was a very low base, but nonetheless, this is a profitable company that's doing very well, we think, and it's due for a further upward move. And I'd like to finish by just looking at Robex. Robex is one of those construction companies that I mentioned earlier, and it's one of the survivors. So it's one of the companies that has survived through the tough times. And there are not many of those construction companies that have survived. And basically, Robex makes money by winning government tenders. So if the government's going to start spending considerably more on infrastructure, then Robex will be at the front of the line there to win more tenders. In its results for the year to the 28th of February, revenue was up 31% and headline earnings per share were up 263%. And then in a trading statement for the 6 months to the 31st of August 2022, headline earnings per share is expected to rise a further 10 to 20%. In the chart, you can see that the share has been falling for about 6 months, and its price earnings ratio is now under 10. We see this as a potential recovery stock, so it's something for you to look at and to consider. Folks, that's what I have for you today. I hope that you found something of use in there. We will be delivering the final confidential report on the first Wednesday in December, so look out for that. Otherwise, thank you very much for listening to me.